You're listening to Insights with Philip Wilson, where the discussion focuses on how to maximize Social Security benefits. Considering there are 567 ways to file and 3,000 rules for filing, it's no wonder that 90% of those who file for Social Security do not receive their maximum benefits. Listen in as Philip Wilson, who is certified in Social Security claiming strategies, outlines what you need to know to get the most from your Social Security benefits.
Today we're going to have part two of the discussion about moving forward financially after a divorce. Moving forward financially after a divorce. Looking at the various financial things that need to be discussed and action need to be taken after a divorce. These areas are generally the biggest mistake areas that I see. A lot of things not being addressed, and I think a big reason for that is someone coming out of a divorce doesn't have a lot of people around like when they were first going through the divorce, and a lot of things get missed. And I just find that this is probably the area that I need to encourage people the most. So we're looking at decisions that need to be made after a divorce, financial decisions that need to be made. Last week we started talking about the house. A lot of issues involve the house, affordability, the budget, school systems, the kids, the neighborhood, their friends, all these different things. You know, pretty tough decisions that parents need to be making for their kids as far as where they are going to live. You know, are they going to keep the house? Are they going to sell the house? Are they going to find something less expensive? Are they going to be able to find something in the school system, and so forth? But the biggest problem that I see in this particular area is that a mortgage is required for all of these decisions. Just about everything you do in this type of decision, whether it's refinance, pay off debt, pay off an ex, downsize, find a new home, everything requires a mortgage. And the biggest amount of stress that I see in this situation is not understanding the rules associated with the mortgage as they relate to a divorce. So we started talking last week about the different rules, and these are rules that have really changed since 2008 that cause someone not really able to fulfill their obligations of the divorce decree and being able to take care of these things in a relative time frame. Most of the time coming out of a divorce, people have about 6 months to complete a refinance or sell their home and move on or something along those lines. And you'll find as we go through these things that 6 months is not enough. So a lot of people are going to be in breach of the agreement and not really realize that. So my goal here is for you to understand that and see these different situations so that you can talk to someone, renegotiate those types of deadlines, and not be in a breach of situation. Last week we talked about the two elements that lenders want to see: a stable income and credit. We talked about stable income, the importance of continuation of income. We also talked about how reentering the workforce isn't necessarily considered stable income. Alimony and child support, you have to show that someone has been receiving that for 6 months or more in order for that to be counted as a stable income. But this week I want to pick up where we left off, and that is to talk about credit. The most common problem situation that I see in this area for someone going through a divorce is when they have joint debts. Husbands and wife have purchased automobiles or other assets by qualifying on both of their income, both of their credit history. After the divorce, these debts are split. One party will assume one debt, another one party will assume the other debt. The problem is that the debts were originally made in the name of the husband and wife, and they're still in the name of the husband and wife. Just because the divorce decree says that you are released from making that payment doesn't mean that the lender is going to release you. And this is a big problem. So even though the divorce decree says the ex is responsible for the debt, doesn't mean the lender won't come back on you. This loan was made to husband and wife based on your income, your credit history. Just because you're no longer together and the divorce decree says that one party is going to be responsible for that doesn't mean the lender looks at it that way. they're under no obligation to release you from that liability. So these joint debts become a big problem. They become a problem because people cannot qualify for a mortgage loan with that debt. You have to show that the other party is making that payment for 12 months or more for it not to be counted. So you're going to have to go back 12 months and show that the other party has made that payment on time, show a check, show where that lender has been paid or that credit issuer has been paid on time for it not to be counted against you. And so the biggest problem is because it's on your credit report. The other situation that happens is when late payments are made, it affects both parties. So once again, just because you are released through the divorce decree for that debt doesn't necessarily mean it's not going to affect you. So where I really want to pick up today is to begin to talk about what you can do to protect yourself in those types of situations. Not only will a late payment affect your credit, but it may prevent you from being able to do what you need to do. So what would you do? If you have a joint debt that you're not responsible for, that an ex is responsible for, what do you do? Well, the first thing you could do is to require the ex to pay off that debt, to refinance it, put it in their own name. You know, this is something that generally should be done through the course of the negotiation when the divorce is being settled. So most of the time afterwards, there's not really too much that people can do. But the obvious best solution would be to refinance so that you're taken off of these debts and they're in the ex's name only. Therefore, they will not be on your credit report and the account is closed. But quite often, that's not going to happen, either because the other party doesn't want to do it, or they're not able to qualify on their own, or maybe the credit history is going to prevent that from happening, and there's not really any way to refinance. So what do you do? Well, what you can do, the best thing you can do is what we call a credit freeze. And what a credit freeze is that you go to the lender or to the credit issuer and you request that no additional credit can be used on this account. And this would be usually in the situation of something like an equity line or a credit card. Most of the time, those accounts are set up with a limit and a balance. And the limit generally is going to exceed the balance. So what you're trying to do is prevent the other party from running up additional debt on these obligations, and that's called a credit freeze. So you can this is a joint debt in the eyes of the issuer. So you can go to them and say, I do not want to have any kind of additional debts created. I do not want any additional purchases on this account. And that is the number one thing that you need to do, in particular with equity lines. I see all kinds of people that have these large equity lines set up on their houses that have very large limits but no balances, or very low balances. Several $100,000 of equity line limits with very low balances. And you do not want to give the ex the ability to go run up that debt, because you will be responsible for that. Just because the divorce decree says that you're no longer married, you are not released from the liability. This is a joint debt. You sign the paperwork. If they default on this, the lender could come after you. So just because the divorce decree says the ex is responsible doesn't mean that that's the way the lender is going to see it. So a credit freeze is absolutely vital. You need to make sure that someone cannot put additional balances on these credits that are going to come back potentially to haunt you. That's probably the biggest change in 2008 was the tightening of these situations, the tightening of credit in general, how difficult it is to refinance these types of things. So the two things that you want to do, one is a credit freeze, the other is you want to check on the payment. This is a joint debt that you took out with the ex and yourself. You have every right to check the payment history on that. You can go to the credit issuer. Most of the time you can register online for that. You can check to see whether or not the payment's being made. What I encourage people to do is to be proactive in this area. They need to make sure that someone is making the payment, because those late payments will come back to haunt them. They will show up on your credit report. So in the situations that you're not able to refinance the debt, or the other party will not refinance that debt, you do not want them to make additional purchases, and you want to keep a check on whether or not they're making the payment on time. If they're not making the payment on time, then you want to be proactive as best you can to protect your credit. The worst thing in the world would be that you're not responsible for that debt, and yet the other party is being liberal in terms of making the payments, and it has an effect on you and what you can do. So let's also talk about credit history. A lot of people coming into this type of situation have missed some payments, maybe through the course of the split up, and it's what can we do about that? Credit scores have been something that have risen to importance over the last couple of decades, and they're really just a fact of life. And the biggest encouragement that I would give to people in those situations is that the only real way that you can mend your credit score is through a history of good payments. Generally, a credit score is the most affected by your payments in the previous 24 months. And if you have a clean history for 24 months, you're generally going to have a good credit score. So the encouragement I would give to you is that time heals all wounds. And it's going to heal those types of wounds. If you have had late payments, it may be a question of waiting for a year or two, but it will heal those wounds. So all is not lost. If you do have those late payments, you should be able to come back and obtain credit at a future date. It just generally might be something that you have to wait for a couple years. The other issue that affects credit scores are when credit cards are maxed out. And this is also a situation that I see with a lot of people coming out of a divorce. Most people don't realize that it's not just payment history. It's also if you've maxed out your card with respect to the balance. And this has the biggest impact upon credit scores of anything other than payments. And when we come back from the break, we'll pick up this. Welcome back. We've been talking about credit scores and the effect that negative credit will have on someone coming out of a divorce, preventing them from borrowing, preventing them from doing what they need to do, causing them to have higher interest rates, a lot of different implications associated with that. Just very briefly, the biggest issue here is when we have joint debts, and a joint debt in which the ex is responsible for that payment and doesn't make the payment on time, or someone has late payments during the course of the divorce. What can you do? Is your credit ruined forever? Well, first of all, we started talking before the break about credit scores, so let me just pick up there and just talk about that a little bit. Credit scores are somewhat misunderstood. A credit score is a statistical prediction of your ability to repay a loan. And lending is very automated these days. And basically what lenders have done is they looked at patterns of good loans, bad loans, payment histories, and so forth, and they came up with statistical predictions of your ability to repay a loan. So the higher your credit score, the better a risk you are. So much of lending falls upon these credit scores. So what causes the credit scores to go down? When you have a low credit score, you're going to have a hard time getting a loan. What causes that? Well, there really is a couple things. And one is your payment history in the last 24 months. That's one of the biggest factors. The second factor I mentioned before the break is when you are maxed out on your credit cards. When you have a balance that exceeds 50% of the limit, it's going to lower your credit scores. I've seen an awful lot of people who have never missed a payment their entire life, but they're maxed out on their credit scores, and that really punishes your credit scores when that happens. And there's no real way around that. Time heals the wounds of late payments. The sooner you have good payments, you're generally going to have 24 months of good payments to obtain a loan. One of the things we do encourage a lot of people to do is to consolidate their debts. That typically is something that most people need to do, that consolidate their bills, make them affordable and so forth, but it has the added effect of raising your credit scores. Because when we pay off those balances associated with the credit cards, your scores are going to go up. One other thing I want to just mention before we move on to some other topics, you do have the ability to check your own credit scores. The government actually has a website that you can do this once a year for free. It's called annualcreditreport.com. And we recommend to all our clients that they check this once a year. They look at their credit. They might see some accounts on there that are maybe not their accounts. They might see some late payments that are not accurate. It gives people the opportunity to dispute those situations. Everybody, as a general rule, whether you've been through a divorce or not, they need to pay attention to these kind of things. So let's move on to some other issues outside of the house. The biggest issue being the house and the mortgages and so forth. What are some other areas that people make mistakes in? Well, one of the areas that I see a lot of mistakes in is when the updating of people's wills and their beneficiaries. It's somewhat common sense that you need to change those things, but I typically find people miss something. They miss their 401ks, they miss their IRAs, they miss something associated with those beneficiaries, and they have not properly updated all of their life insurance, IRAs, 401ks, and their will. Most people think about doing that with some things, but they forget to do it with a few other things. I also want to mention that we recommend people buy life insurance, and this is very typical coming out of a divorce situation, to protect the recipient of alimony or child support. And this is very common, that as part of the divorce decree that the person making the payments will be required to purchase life insurance to protect those future payments. So the child will continue to receive their child support, or the ex-wife will continue to receive the alimony. That is a great idea. Most of the time that's being suggested by the divorce attorney. But the caveat to that is that I want the person who is the beneficiary to also be the owner. So when you purchase a life insurance, I want you to be the owner, even though it's on the life of another, and that would be your ex, because I want you to have control. One of the issues that I see here is that people who are not the owner don't necessarily know if the payments are being made, the premiums are being made. I've seen situations that years after the fact, someone has passed away and we found out that the insurance policy lapsed. So control here is important. If it's important enough to purchase the insurance to protect the alimony and the child support, you need to be the owner. You need to get the premium notices. You need to get the correspondence with the insurance companies to make sure everything's in order. Another thing that I want to mention that's somewhat new, there's actually also a disability insurance that can be used to protect the stream of income for child support and alimony. It's somewhat new. It's come around in the last 4 or 5 years. I think it's very worthwhile to look into. Just like with the life insurance, it's also something that people need to be protected with. Protect that stream of income, that stream of alimony or child support. All right, let's finish out this segment by talking a little bit about Social Security. We covered a lot of these things in our series on Social Security, but in particular, I want to talk about the divorce benefits. Divorce benefits are greatly misunderstood for a number of reasons. Well, the biggest reason is that it's not a benefit that's mentioned on your earnings statement. So most people are not even aware of it. I do meet some people that are aware of it, but I meet more people that are not aware of it. And that's because they have a Social Security statement. If they were to go to the website and pull that earnings statement, it doesn't have any mention of the divorce benefit. It doesn't say anything other than what your benefit is for your own Social Security. It doesn't say anything about divorce benefits, or it doesn't say anything about spousal benefits, which we covered in that podcast. And that's a real problem. Because what happens with a divorce benefit most of the time is that the person filing for it will receive significantly more money, because that the amounts that they receive are based on the ex's work history, not your own. And the typical situation is a woman who has stayed home, who sacrificed their work history to take care of the children, and they don't have a lot of benefits. So even though the earnings statement says this is what you have earned based on your payroll taxes, they actually are going to be better off filing on the work record of their ex because it's going to be higher. So what qualifies someone for a divorce benefit? Well, in order to qualify for a divorce benefit, you have to be single, age 62, and married for 10 years or more. If you weren't married for 10 years, you're not going to qualify for a divorce benefit. Single, age 62, married for 10 years or more. If you're remarried, you're not going to qualify for a divorce benefit. You have to be single. So the biggest area that we use this in is when somebody does not have a high income history, and they would be better off filing on the work history of the ex because it's going to be greater. Now, most of the time this becomes a problem, not so much for the eligibility for the divorce benefit, but for verifying it. A lot of people that I meet with, we're talking about the divorce benefit and whether or not it's going to help them, but we don't really know what the ex is making. We don't really know what their work history is. We don't know anything about them. And typically there's some hiding of income associated with that. So usually the first step for most people is just to verify what the divorce benefit is, and then you can determine whether or not it's going to be something worthwhile for you to file for. You've got to verify what the amount is to determine whether or not it's going to be better than your own benefit, if it's going to be higher than your own benefit. Now, how do you do that? Well, the only way you can do that is actually by going down to the Social Security's office and taking your divorce decree and a marriage certificate and proving to them that you've been married for 10 years. If you were married for 10 years, you can verify that. This is a legal benefit that you're entitled to if you were married for 10 years. But once you verify it, then you can meet with your advisor and determine whether or not this type of strategy is going to be the best strategy for you as far as retirement. A lot of people who qualify for divorce benefits because they have a work history, it's not necessarily the best benefit. It's not necessarily the best way for them to file, because a divorce benefit is equal to 50% of whatever the ex would make at full retirement. 50%. So is that 50% greater than your own benefit? Well, you're not going to know that until you verify it. And then the second issue that I want to cover very quickly is there's actually two divorce benefits. There's actually a regular divorce benefit, which is 50% of the ex's full retirement age benefit, but there's also a divorced widow benefit, which is 100%. So I do meet a lot of people who have been receiving the divorce benefit for a while. The person passes away, they can refile for that as a widow benefit, and it doubles. So there's two benefits. There's one benefit if they're alive, one benefit if they're dead. And the amounts are very different, but the qualification is going to be the same. You've got to be single, age 62, or married for 10 years or more. But the biggest thing here is I just want people to be aware that this is a benefit that they should verify to determine whether or not it's going to be a benefit for them. And that pretty much wraps up the series about divorce. I would like to take a second just to introduce next week's topic. Next week I want to talk about specific planning situations that need to be looked at if you lose a spouse. You know, what are the financial decisions that need to be made for someone who's lost a spouse? It's a topic that's very important to me. It's one that I speak on quite a bit at churches and some widow support groups around town. And we will cover that probably for the next 2 weeks, and I'll look forward to talking to you then.
You've been listening to Insights with Philip Wilson, an Alabama registered investment advisor. Learn more by visiting his website at ssmistakes.com or by calling 205-868-9297.